Hi there, and thank you for clicking on our market update for April 2025. This one's entitled Jekyll and Hyde, as clearly, depending on which day you look at the markets, based on policy announcements, they're either really market friendly or, well, quite the opposite. So, a lot to talk about, a lot to go through, because clearly a lot has happened over the last 3 or 4 weeks. So, let's jump to it. This is our disclaimer. I'll just pause here for a moment. Feel free to click pause and read it in its entirety. So yeah, we often commented over the last few months, in the previous months, that the markets had proven relatively resilient, even though there was a lot of uncertainty and a lot of unknowns around policy and tariffs and what that was going to look like and what it was going to mean. And for the most part, the markets held in relatively well, up until, probably early March, when they started to show, I guess, exhaustion over trying to deal with all the uncertainty being bounced around on the trade front and other factors as well. And I think one thing that kept the market a bit more resilient was, decent economic data, decent earnings data, and sort of the core fundamentals, and, had a bit of an air of optimism out there. But then came along, the back half of March and April. And, in March, we saw, one of the fastest corrections in history. So that's a drop of 10% for the S&P 500, about sixth fastest over about the last 100 years. And then April was obviously a very down month for the first part. We're recording this in the middle of April, so still half a month to go. But clearly, it's been a much more challenging market with a decent bounce off an oversold bottom. But clearly, that uncertainty and tariffs, and especially with those announcements from the Rose Garden, with that little graphic billboard of what tariffs would look like, really rattled markets and created a fair bit of really high volumes and a lot of repositioning across markets. We would highlight, there was a little bit of talk, especially in those big days, and they were big days in, the first half of April. You had back-to-back days of down 5% or 4 or 5%. You had a big up day of plus 10% and then back down 5%. And, that kind of volatility obviously is pretty unnerving, and a lot of money moving around, and I think there was a lot of leverage taken out of the market, and that probably exacerbated some of the moves. But one of the more challenging aspects, I think, for investors was during that period of weakness, bond yields all of a sudden started to rise, especially in the U.S. and the U.S. dollar started to fall, and typically you want those bond yields to be coming down in that environment to provide some stability. Yields down, price up for the bond portion of the portfolio, and that became a bit challenging for a few days. And the U.S. dollar, for the last few decades, it's been a bit of a safe haven kind of currency, but that is not the case. And one reason for that is because the root of this problem and uncertainty is America, and that obviously is not weighing well on the U.S. dollar, which has been depreciating even against the Canadian dollar, which we're probably more at risk from tariffs, but again, the bids sort of faded away on the U.S. dollar, and that created a fair bit of U.S. dollar weakness. If you had to, and I don't know if there's a silver lining in any of this, there probably isn't. Well, I mean, we never know with policy, because you never know if a policy is the right policy until 1 or 2 years later. So who knows? But certainly the approach they're taking to policy in the U.S. has been relatively disruptive for markets. But the one good news, and you have to sort of, not sure if this will kick in or when it'll kick in or how much it'll kick in. But the one good piece of news is this is all self-inflicted. Like, this isn't bad recessionary data at this point. This is all policy announcements causing market volatility, which, the silver lining is those policy announcements can flip on a dime, which they obviously have on a day-to-day basis. And that is certainly a more positive aspect than something that's sort of broken in the market, which right now there doesn't seem to be anything along those lines. Now, of course, tariffs are the big thing. And again, we've talked about this and everybody's talked about this, and we're all getting tired of talking about it. But, tariffs on, tariffs off, delayed, adjusted, paused, whatever you want to call it. It's a bit of almost an experimentation, you could almost look at it as an experimentation on what the market can take and what it can't. And now we're obviously in a 90-day pause and with some negotiations going around in the background, and that's helped the market find a bit of a footing underneath it, and recoup some of the losses from earlier this month. But again, this can pivot pretty quickly and pretty dramatically, and just to on any given day, they can be coming out with policy announcements that are positive, whether they're pauses or delays or reversals in some of the previous policies, or there are negative policies. And that's where we get this sort of Dr. Jekyll and Mr. Hyde analogy, because, on any given day, it can be certainly move markets in one direction or the other. And this chart just highlights a lot of the single days where some of these big announcements came out and what markets did. And you can see clearly these policies are moving markets, but they do appear to be slowing down a little bit. And I think that's a bit of a positive aspect. And again, I think that's helped the market recover a little bit at this point. But let me tell you, if I don't know if the analogy is correct, but if you get punched in the face enough times, your mood really sours. And if you look at any of the sentiment data, it is, really, really negative. Like we're talking, this chart's the American Association of Individual Investors, and it's, the percentage of people who are bullish over the next 6 months versus bearish for the S&P 500. And, it's as bearish as it was during the sell-off in 2022. It is, in fact, more bearish than it was during COVID, which, you have to kind of scratch your head. Yeah, tariffs are bad, but let's just admit COVID's worse. But again, that's why, sentiment's interesting. It's always, people focus on sentiment a lot because it's quicker data, and it very often is a bit of a leading indicator. But, sometimes when, people are generally upset or uncertain, sentiment can probably overstate, people's actual behavior. But nonetheless, investor sentiment, very negative. And it's not just from the investor side. If you look at the consumer confidence, this is consumer confidence going back to the 80s. Typically, when it drops like this, you do get recessions. But again, we would point out that consumer confidence has really fallen out of bed over the last couple months. And even on the manufacturing side. So this is manufacturing surveys on the bottom right-hand side, and it is showing slower and slower activity. So the sentiment clearly, as a leading indicator, has gotten very negative. But then, of course, the question comes, should we take it at face value or with a bit of a grain of salt, because everybody's pretty much upset anyway. And again, and this is all just driven by policy announcements. So maybe it's exacerbated to a certain degree. Now, if you turn to, instead of sentiment data, if you actually look at the hard data, so this is the actual economic numbers, it's not too bad. Forecasts for economic growth have come down a little bit globally, but really not all that much, and still showing decent positive growth. You look at job growth is still positive. It slowed down a little bit in Canada, but still job numbers are positive. And then even if you look at earnings estimates have come down a little bit. They're still, the US is, forecast to sort of grow 8-9% earnings this year relative to last year, a little bit less in other areas, but still, revisions, the estimates have come down a little bit, but not all that much yet. So the hard data is actually, I would say, pretty fine right now. The question is, what does that mean going forward? We took a look at some of the faster moving hard data too. So these are just some of the indicators that give you some indication of where the data is heading, but these are just more timely because, again, the problem with a lot of economic data is it is backward looking because it's compiled and totaled up and then reported. And obviously that takes time. So it's, has a certain bit of a rear view approach to it. Some of these indicators, some of these data series are just a little bit more timely as far as what's happening either very, very recently or even almost live kind of data. And, initial jobless claims is a weekly data series. Those have not ticked up at all. And that's even with all these sort of announcements of layoffs in the US from, the Department of Government Efficiency. Again, a lot of those folks have been rehired, but still, we have not seen a material rise in initial jobless claims. We looking at TSA security checkpoints, that's how many people are going through security at airports. People are still flying, like that hasn't started to show signs of weakness. Looking at open table trends, in other words, people booking restaurants, those trends remain to be relatively healthy. And point of sale. So this is credit card data, still showing decent amount of consumer spending. And again, like that certainly doesn't match with what you see in the sentiment data, which again is why you sort of go, well, maybe that sentiment data is a little bit too negative compared to what people are actually doing. And it's the old adage where, if people are given a survey, they may answer it one way, but then they behave another. We've all sort of seen that over time. But again, it's certainly a little bit more positive on some of this faster moving economic data. And then even looking at the weekly oil and gasoline demand. So again, if the economy was really slowing down, those tend to start to roll over, and we have not seen much deterioration. Oil and gasoline demand remain relatively stable. But of course, in the investment world, what happens next? So, we had a pretty big market drawdown. We've had a decent, reasonable bounce partway back up over the last few days. And the question is obviously what happens next. And, the tariffs, which we're going to call the Jekyll and Hyde show for now, we have a feeling we might have seen peak tariff uncertainty from that presentation in the Rose Garden. That was much more than anybody had anticipated, and really highlighted the uncertainty and the unknowns around it, and how far the administration at least said they might go. That's how we're viewing policy at this day and age, because nothing ever is concrete. In fact, they've really collected almost nothing in tariffs anyway. So, it's always, what does it really mean? Where does it settle out? But that was, that may have been peak uncertainty for tariffs. And I think that's possibly good news. And, even with fewer announcements, even if some of them do come out, if they remain fewer and far between, like the market can probably find some sort of footing around that. Prices have come down to sort of adjust for that amount of uncertainty. And if it's sort of that amount of uncertainty remains stable, then markets can probably, find their footing as they have been over the last little while. But that can change pretty quickly. And again, it can change any day. But, I think on the tariff side, for now, a little bit more encouraging than what we've seen over the previous few weeks. But here comes the hard part. So, faced with uncertainty, corporations, what do? They're obviously, sort of hamstrung. They can't listen to what the policy is because it keeps flip-flopping around. And it's really hard to make decisions. So I think that's starting to weigh on things. And, I think companies can manage uncertainty for a while without much of an issue, but I think it's been going on long enough. It's probably going to start to creep into the earnings and at the very least start to creep into forward guidance. And I think that's going to be the challenging part. I highlighted that estimates haven't come down very much, but again, why would they? I mean, if you're an analyst covering a company, how can you sit there and say, you know what, we're going to reduce this company's earnings estimates by 10% because of, the potential for tariffs? Like, you're just flipping a coin at that point. So I think most analysts actually haven't revised down numbers because they're waiting for the companies, which again, they don't have much clarity either. But for them to actually reduce their guidance or highlight the uncertainty. So again, I think this earnings season and the next one are probably going to be pretty important. If we do start to see companies pulling guidance or revising down, I think that could be a pretty big negative for the markets. And then there's that economic data. Like, does that negative sentiment and, areas of softness, does it actually start to show up in some of the harder economic data going forward? And, I think that becomes a challenge because, these last two, earnings or the hard economic data, I mean, if a tariff announcement causes the market to go down a whole bunch or the bond yields to go up, we've clearly seen that they can reverse course and change their tune and change what they're saying, and the markets rebound. We've all obviously seen that over the last little while. If earnings start to deteriorate or the economic data starts to soften, a tweet can't solve that. A tweet saying we're going to back off a little bit doesn't actually make the economic data get better immediately. So, I think that's going to be a problem because it's not, that becomes a bit more of an issue for the markets. And if either of those start to sort of deteriorate in any meaningful way, we do think that could lead to a lower bottom in markets this year. Again, not necessarily going to happen, but I think in our minds, that could create a better buying opportunity for 2025. So we're still leaning and staying a bit more on the defensive side. Just looking at our multi-asset strategies, we're roughly neutral on equities, but I would point out our equity exposure does tend to have a bit more of the dividend factor and a bit more on the international side, which makes it a little bit more defensive. We are a bit under on bonds, and we are holding extra cash and more diversifiers as our sort of preferred way to add defense to the portfolio at this point. On the equity side, we are underweight Canada. We are a little bit underweight on the US, and we are holding more international, which has worked out quite well so far this year because international markets have been quite strong. I mean, a lot of the changes on the fiscal side internationally are encouraging, and the valuation backdrop, well, not as cheap as maybe a few months ago or 6 months ago, but the backdrop still is pretty encouraging. And I would even point out the European consumer is actually in really good shape. They have not been spending very aggressively over the last few years, unlike their American counterparts, and their balance sheets are really strong. So there's been more austerity elsewhere and more deficit spending in the US, both at the government and at the consumer level. And I think that sort of sets up for the international side to have a bit better footing going forward. So we think this relative outperformance on the international side still could have legs, even though it's off to a very strong start this year. And then on the US, our US exposure, we have a decent amount of that. It is equal weight, and that sort of helps neutralize some of that exposure to the Mag 7 or Mag 8 or however mags there are at this point in time, which again are the US has certainly a concentration issue, and we sort of mitigate some of that risk as well. On the bond side, we are underweight bonds, but we are carrying a fair amount of duration. And the reason being, not market duration, we're a little bit under that, but that still has us up there around 6. I would point out, even though duration was kind of a bad thing in 2022, if the next stage or the next problem for this market does turn out to be softening economic data, duration probably isn't a bad thing to have within portfolios. So we're comfortable with some duration exposure. That being said, we are underweight bonds, so our exposure is mitigated a little bit from that perspective. And we're also pretty light. We're really focused on investment grade and government, so our credit quality is pretty high across our bond allocation. But I'll tell you, it's the diversifiers that have been helping quite a bit so far this year. Has really helped our strategies relative to a lot of our peers. Again, in the diversifier space, we do have some vol management strategies on the momentum side. We have gold. We have some income harvesting strategies that have worked out quite well, which I'm just going to touch on a little bit here. Defense is always hard because every correction, every period of market weakness is very different. Like I highlighted at the beginning, normally when markets sell off, bond yields do not move up, and the US dollar does not move down. So, I think it really reinforces that every market environment is different. This one is certainly different. If there was any doubt before the last few weeks or the last few months, but this one certainly is different, which I think really requires you to diversify how you're getting defense in your portfolios, whether it's the dividend factor or more value, whether it's better geographic allocation, whether it's on the bond side. And again, we sort of get defense in a number of different areas. We have a momentum strategy that we use in the purpose tactical asset allocation fund, and that helps as well. And it's a different kind of defense than just bonds or other components. And we've also started to use premium yield, which is an option writing strategy, but it is a vol management strategy as well, and that has done quite well for us so far this year. Its drawdown has been pretty minor, and the income is quite healthy. And then gold. Listen, we own a lot of gold now. We haven't been buying more, but we have had a decent gold allocation for quite some time now, and gold has been working really well. Maybe too well, but for now we're certainly enjoying our gold exposure. But I think what it really highlights, and gold, lever hate gold, it certainly has a very strong track record of when there are problems in the market. It holds up really well and does provide a really good, often unique kind of diversification tool for a portfolio. So we're still pretty positive on gold. Again, we do look at how well it's done and sort of scratch our heads going, should we start to take some off the table? And that may certainly happen. But again, I think what we're trying to highlight here is on your defense, on the defensive contributors for a portfolio, the key is they can't all just be bonds anymore. They can't all be alts. You have to look at a number of different sources for your defense, because all these kind of market corrections, I think that we've been going through, and these kind of market dynamics are just very unique, and figuring out which ones are going to work and which ones aren't is going to be very challenging. So having that diversification across defense, I think, is very important. I'll just touch on our multi-asset strategies. We have a pretty unique approach in this. We are not a static asset allocator. We actually do make changes. Our asset mix changes not every day or anything like that, but it does change on a somewhat regular basis based on our evolving view of markets, and then also price. Obviously everything I said here was pretty negative, but let me tell you, we do have price levels that we would be comfortable adding more exposure, even more exposure into the US. We have already done a little bit earlier, admittedly maybe a bit too early, but nonetheless, the best way to mitigate risk in the market is to buy something at a lower price. So I think being a bit more tactical is going to pay dividends for portfolio performance going forward, and it has done over the last little while. We combine active and passive, so we're not all passive, we're not all active. We tend to be a little bit more active in less efficient markets, and we're looking at how each piece contributes to the overall portfolio. And again, we use different kind of diversifiers. So that's where our gold fits in. That's where our momentum strategies fits in. That's where our premium yield strategies fits in. I think it's important to diversify how you're even getting diversification in this day and age. So I think we have a pretty unique approach to the multi-asset space. If you're interested to learn more, obviously we publish the Y report and these macro updates. We have lots of content. We also, for followers who have subscribed to our macro insights and Y report, anytime we trade in our multi-assets, we send a trade rationale shortly thereafter to give you an idea of how things are doing. And again, we've been running multi-assets since back in 2015, but the fund versions were launched a little bit over a year and a bit ago. I guess it's getting close to a year and a half. But nonetheless, this is obviously a challenging market environment, and that has lifted us up to the top amongst our peers. This is just their peer ranking for the Purpose Active Balance Fund, and we are second percentile year to date. So we are probably defense first as far as managers, but again, I think in this kind of market environment, that is the way to go. Again, if you want to hear any more about any of these, feel free to subscribe or reach out to your wholesaler or us directly. Thanks for listening, and happy investing.